You have $100,000 to invest, but you're stuck deciding between two powerhouse options, index funds or ETFs. The question is, which one will add the most to your portfolio? In today's video, I will explain how two investment options are alike and different. I'll also show you and John a portfolio of the top 5 picks from each option. I'll show you how these investment options can turn a $100,000 investment into a multi-million-dollar portfolio. And in the end, I'll also show you which investment option can add an extra $2 million to your portfolio and also pay $30,000 more than the other in monthly dividend income. Before that, let's get to know what we're dealing with here, starting with index funds. An index fund is a type of investment fund that holds a collection of stocks or bonds designed to mirror the performance of a specific benchmark, like the S&P 500 or S&P TSX Composite Index. When you invest in an index fund, your money is spread across all the companies in that index. Index funds are passively managed, meaning they don't try to beat the market, they just aim to match it. However, one important thing to note is that index funds are priced only once per day after the market closes. Now that you understand how index funds work, let's see how ETFs compare. An ETF works in a similar way. It bundles several investments together to track a benchmark. However, unlike index funds, ETFs trade on stock exchanges throughout the day, just like individual stocks. This gives you more flexibility to buy or sell at any time the market is open. Many ETFs are passively managed too, but actively managed ETFs are gaining popularity as well. Despite these differences, index funds and ETFs actually share a lot in common. Diversification is one of the cornerstones of sound investing, and both ETFs and index funds offer it in abundance. Instead of picking individual stocks, a single ETF or index fund can give you exposure to hundreds of companies, spreading out your risk and reducing overall portfolio volatility. Besides diversification, another major benefit is the lower cost structure. Because these funds are typically passively managed, they have lower fees than actively managed mutual funds. There's no high-cost research team or constant trading, just straightforward market tracking. And over time, that cost efficiency supports stronger portfolio growth. Historically, passively managed funds have outperformed many actively managed funds over time. With fewer fees and lower turnover, your returns have a better chance of compounding effectively over the long haul. But while the similarities are important, it's also crucial to understand where ETFs and index funds fundamentally differ from each other. ETFs can be traded throughout the day, while index funds are priced only once daily. This means ETFs will give you more control over the price you pay or receive, especially during volatile market conditions. That flexibility can matter to investors who like to time their entries and exits more precisely. Both ETFs and index funds charge a management expense ratio, or MER, but ETF fees are often slightly lower. However, ETFs may incur trading commissions with some brokers. Index funds usually don't charge trading fees, but may have minimum investment requirements, such as $500 or $1,000. This brings us to the question, how much money do you need to start investing in these funds? ETFs typically have lower entry barriers since you can start with the cost of a single unit. On the other hand, index funds often require a minimum initial investment, making them less flexible for beginners with limited capital. If you wanted to buy an ETF, like the Vanguard S&P 500 ETF, which trades at around $420 per share, you might not be able to afford even a single share right away unless your brokerage offers fractional shares, which some do now. In that case, you could still invest your full $300 and get roughly 0.71 shares of VOO. However, if you tried investing in an index fund like the Vanguard 500 Index Fund, it would require a minimum initial investment of $3,000. In this case, you simply wouldn't be able to invest until you saved up more. Now that you understand the strengths, similarities, and differences of both ETFs and index funds, it's time to dive into specifics. I'm going to show you and John 5 of the best ETFs and 5 of the best index funds you can start investing in today. And if you're curious to know, in the end, I will show you which investment option can add an extra $2 million to your portfolio and also pay $30,000 more than the other in monthly dividend income. Now, let's take a look at 5 standout ETFs and 5 top-tier index funds to decide which investment option takes the win home. First are the ETFs, with Schwab US Dividend Equity ETF on top of the list. It's a reliable, low-cost fund that focuses on high-quality U.S. dividend-paying companies with strong balance sheets, perfect for long-term income and capital growth. Second is the Invesco S&P 500 GARP ETF. It combines value and growth by investing in S&P 500 stocks with strong earnings and reasonable valuations, a great pick for those seeking smart, sustainable growth. Third is the Wisdom Tree U.S. Value Fund. It targets fundamentally strong companies trading at attractive valuations, making it a solid choice for those who lean toward a value investing strategy. Fourth is the Invesco Dorsey Wright Financial Momentum ETF. It builds around a momentum strategy in the financial sector. This ETF selects top-performing banks, insurers, and other financial stocks, ideal for trend-following investors. And lastly, we have the iShares Core Dividend Growth ETF. It focuses on companies with a consistent track record of growing dividends over time, providing a steady income stream with long-term capital appreciation potential. So here's the list of these ETFs with their dividend yield, dividend growth, and average share price appreciation. Now on to the index funds. First is the Fidelity Mid-Cap Index Fund, which tracks mid-sized U.S. companies that offer a balance between growth and stability, making it ideal for building wealth over the medium to long term. Second is the First Trust Dow Jones Select Microcap Index Fund, which gives you access to fast-growing microcap U.S. companies, great for adding high growth potential to your portfolio, though with slightly higher risk. Third is the Fidelity Total Market Index Fund. It provides broad exposure to the entire U.S. stock market, from large caps to micro caps, making it a great core holding for truly diversified investing. Fourth is the Vanguard Information Technology Index Fund. It captures the performance of top-tier U.S. tech giants like Apple, Microsoft, and NVIDIA, perfect for those who are bullish on the future of innovation. Last one is the Vanguard Mid-Cap Value Index Fund. It focuses on undervalued mid-size U.S. companies with solid fundamentals, ideal for value-focused investors seeking steady growth opportunities. Now, to bring everything together, I've used forward yield, 10-year dividend growth CAGR, and 10-year average share appreciation of these ETFs and index funds for my projection. You'll see how in a minute. Forward dividend yield for the ETF portfolio is 2.38%, and for the index fund portfolio is 1.81%. 10-year dividend CAGR for the ETF portfolio is 14.08%, and for the index fund portfolio, 12.48%. 10-year average share price appreciation for the ETF portfolio is 8.47%, and for the index fund portfolio, 9.2%. If you're wondering how to calculate these key metrics for your own portfolio, it's actually quite simple. Let's take the 5 ETFs and index funds I've shown you as an example. To find the average current dividend yield, you just need to add up the dividend yields of all the investments. For this example, let's use our ETF's dividend yields and divide by the total number of ETFs, in this case, 5. So if we have a total of 11.9% in dividends, we divide that by 5, which gives us an average dividend yield of 2.38%. You can use the same method to calculate the average dividend growth and share price appreciation for both ETFs and index funds. Just add up the figures for each option and divide by 5 to get the overall average for your portfolio. Now let's bring John back into the picture. He's investing $100,000, and we're going to see how these two portfolios grow over the years without any additional contributions, assuming dividend reinvestment and no further investment out of pocket. Starting with the index funds. From our calculations, we know that the portfolio of index funds has a dividend yield of 1.81%, which grows on average by 12.48% and has an average share price appreciation of 9.2%. Based on these metrics, here's what the projection of a $100,000 investment looks like. In the first year, the portfolio will grow to $111,010. After 10 years, it'll be valued at $291,739, still showing decent growth. By 20 years, the portfolio value stands at $914,204, and after 30 years, the index fund portfolio will be valued at around $3,159,435, with an annual dividend income of $127,827, which equals about $10,652 in monthly dividends. Overall, the total value added by index funds to your portfolio will be $3,059,435, with $2,175,450 coming from capital appreciation and $883,985 from reinvested dividends. Now let's apply the same $100,000 investment to the ETF portfolio and see what happens. The ETF portfolio has a dividend yield of 2.38%, which grows on average by 14.08% and has an average share price appreciation of 8.47%. With a $100,000 investment, in the first year the portfolio will grow to $110,854. After 10 years, it'll be valued at around $298,382. By the end of 20 years, the portfolio, thanks to higher dividend yield and growth, which means higher dividend reinvestments, will reach $1,085,143. And after 30 years, the portfolio value reaches $5,501,264, with annual dividends of $529,928, which translates to about $44,161 in monthly dividend income, enough for a stress-free early retirement. Overall, the total value added by ETFs to your portfolio will be $5,401,264, with $2,664,176 coming from capital appreciation and $2,737,080 from reinvested dividends, all starting from just $100,000. So, based on this, the ETF portfolio clearly outperforms over the long run in terms of total returns and dividend income. With higher dividend yield and stronger dividend growth, it builds more wealth and generates significantly more passive income over time. But that's not to say that one is inherently better than the other. Both ETF and index fund portfolios have their strengths. ETFs may offer more income and flexibility, while index funds often provide broad market exposure and simplicity. Don't have $100,000 for investment? No worries. Click the video on the screen to find out how to make $6,000 per month with only $20 per week.